Hi, everyone. It's Matt Williams from JTM Williams Capital Management. This is the review for January of 2026. I'm getting this out a little bit later than usual due to some issues with the weather here in this region of the country here in the past week. So this is going to be a little bit more, a little bit brief. First off, please pay attention to the disclaimer at the beginning of this video. None of the positions, indexes, or ETFs that we're covering here are a recommendation to buy or sell any security. So with that out of the way, I just wanted to go over, let me share my screen. Okay, so we're just going to go through these here pretty quick. You'll go over a lot of the same charts here as we did a month ago. So start off with the S&P, still just kind of in this, slight upward, consolidation we've been in here. If we start drilling down a little bit further into some of the major indexes, we'll see that the relative, the NASDAQ still having issues ever since topping out here around Halloween of 2025. Now, on the inverse of that, because of that, we've had some broadening out. So you see that the small cap Russell 2000 has been showing some relative strength. There's been a pretty strong rotation back into international markets here the last month or so. And even with commodities now, I'll get to this a little bit later, but we had a pretty strong movement up in crude oil, nat gas, gold, silver, copper, a lot of other base metals. We had a little bit of a check back here at the tail end of the week. So doing this video today may be a little bit different than some of the things I would have covered here a few days ago. Moving on, we'll drill down again here into the factors. So growth. Much like the NASDAQ's been continuing to, decline on a relative basis. Now, again, that's not any reason to necessarily get too bearish, but it's definitely a yellow flashing line as far as like what I like to see as far as where rotation is. Value, on a relative basis is near a 9-month high. So as we, discussed previously, where, the concentration in the market and a lot of the, tech led sectors topped out around Halloween of last year, there has been a broadening out. Something to keep an eye on here. You're starting to have some defensives finally start perking up relative to the market. We'll see here later. A lot of that's been led by, consumer staples, and which is one of my, risk appetite ratios I like looking at to determine whether or not, there's, adequate, risk appetite in the market for continued advances. Again, broadening out the equal weight's been outperforming relative to the S&P here since Halloween. Same thing, like with that also, momentum stocks have been continuing to roll over. Again, something to keep an eye on. You typically want to see the, more aggressive parts of the market, continue to rally. Moving on, we'll start, again, going to those risk appetite ratios I was mentioning. So again, yes, even though the S&P's been continuing to rally, NASDAQ has been underperforming on a relative basis. Consumer discretionary relative to staples is definitely something I'm keeping an eye on that I'm very concerned about here. Again, not a big red light, but a flashing yellow light in terms of, how I like looking at things. And you can even see that again, the equal weight consumer discretionary to staples looks a little bit better, than the cap weighted. A lot of this is, let's just say, the interplay between, let's say, Walmart, Amazon, some of the consumer defensive stocks relative to Tesla, et cetera. But again, that is something that you normally, want to see these ratios, going bottom left to top right, if you think there's going to be a continued stock market advance. Now, again, here, the high beta to low beta isn't necessarily flashing the same warning signal as, say, discretionary to staples. So at least as far as that, like that is something that I'll look at as far as giving me a early warning sign. You normally want to see low beta underperform high beta for continued stock market advance. Down the credit markets, you are still seeing high yield, outperform relative to treasuries. That's, kind of come back a little bit here in the last week. But again, that's as long as that's still moving bottom left to top right, more of a flashing yellow light than a red light. Moving on now, we're going to start drilling down just in the sectors. Same thing, NASDAQ, relative to the S&P, again, looks very similar just to tech. Healthcare still going sideways after breaking out here back in the fall. Consumer discretionary still going sideways. There's been some advance here in the communication sector. A lot of that's Google and especially Meta recovering here recently. Financials look like they were wanting to break out. Now, a lot of that may not be like if you look at here in a little bit, we're going to look at the bank stocks. Some of this is maybe necessarily Visa, MasterCard, some of the insurers. They haven't been acting as well as some of the large cap banks. continuing to move on now, going to some more of the sectors. Real estate still rolling over. Now here again, it's industrials and consumer staples, have been where there has been a lot of the rotation. So again, just something to keep an eye on. Utilities still underperforming. Materials, a lot of that's in energy. That's your big, your commodity plays, your metals and mining stocks, your base metals, precious metals, energy stocks, some of your specialty chemicals. That's, you can just look at a commodity index and you can effectively tell, why, you're getting some rotation into materials and energy. And getting into, some of the industry levels, semiconductors, even though tech's been continuing to go sideways, we're going to see here just in a second, the semiconductors keep, outperforming on a relative basis. The software stocks, this has been a concern of mine here since the fall, and they continue to keep rolling over. That's your Palantirs, Oracles, Adobes, Microsofts. There's some concern there that a lot of the business development corporations of private credit have lent quite a bit of money to some of the software stocks. Something to keep an eye on as far as contagion. Now, again, going down, bank stocks, look a lot different than financials. They're continuing to show some relative strength. Biotech, healthcare continue to look well. Home construction still going sideways and, getting back again. Metals and mining, bottom left, the top right now. Obviously, there was a decent check back here last week with a lot of the commodities, retreating on Thursday and Friday, but, still, at least for now, bottom left, top right. We'll go to bonds here briefly. Still, 10-year note yield is just right where it was still around October of 2022. So in the longer term, this is just a big sideways consolidation. Shorter term, there's a little bit of an inverse head and shoulders pattern here I'm a little concerned about that could, basically portend going up somewhere around 4.5. Inflation break-evens have bottomed and started rallying. Now, a lot of that's just going to be due to, what commodities are doing. Big thing here last week, and I'll close on this. I might look at, crypto here very briefly, but, gold and silver, after having just massive advances here year to date, had one of their, worst 1 or 2 day spans here almost in, several decades. Silver had a 30% drop. I was joking with someone last week, that silver could have a, 30 to 35% drawdown and just get down to its quarterly moving average. I didn't expect that to happen in a day. But here it is. Just, keep an eye on. Just remember, volatility works both ways, to the upside and the downside. So even after that big of a down move, it is not going to be unusual to have large dead cat bounces. May just want to wait until things settle down a bit before adding exposure. We'll look at Bitcoin here real quick. It's continuing to, let me just back out a little bit. Continuing, you had this, first down move, kind of a bear flag here, and it's still continuing to roll over. Again, it's, pretty much back to where it was around the 2024 presidential election. I'm not going to get into any reason for why that may or may not be happening. Just, but again, on a, relative strength basis, continuing to, move down. But, yeah, like I said, apologies for this getting, delayed, due to some issues here this weekend with the weather. Again, if anybody needs me, I can be reached. Best way to contact me is my email, matt@jtmwilliams.com, matt@jtmwilliams.com. Happy to have a conversation if anyone's looking to have a consultation regarding not just the, markets, but looking at your entire financial picture and helping you craft a good financial plan. Like I said, I'll be, doing one of these here at least monthly moving forward. If you have any questions, please contact me. Hope everyone has a good February.